but margin that has taken a slight dip. And to discuss what led to this very strong quarter and what's the outlook going forward, we're now joined by Amit Uplenchwar, who's the Director of Strategic Business Group at Kalpataru Projects International. Hi Amit, very good morning. Thank you so much for joining us today, and many congratulations on that very strong set of numbers. Now, firstly, let's talk about your order book. It is robust at 64,680 crore rupees and favorably placed another 5,000 crore rupees as well. So, take us to how much of this new order inflow that you have seen, some 14,000 odd crore, is expected to convert within FY26, and what is the current domestic versus international mix? If you could give us, a brief lowdown of that.
No, so thank you very much for having me to begin with. We've had a good set of numbers. Just to tell your viewers, we've had the highest ever Q2 revenue and profits in the history of our company, and that's a good sign. You spoke about our order booking. We are almost close to 65,000 crores of current order book. We have had almost 15,000 crores of new wins as of H1, and we are favorably placed in around 5,000 crores already. And I think we should be able to convert that during this financial year, and should be at our order, guidance of 25,000 plus crores for the year end. I think we should be there at the end of the year.
All right, good to know that. Amit, hi, morning. This is Shrishti also joining in. But in terms of your Q2 performance, that saw a 32% revenue growth. Profit has also seen a very good surge, and so is the margins. But how sustainable is this growth momentum in the second half of FY26? And what are the key levers that can really help you to improve your margins from these levels? And can that really see that mark to be in double digit?
So, let me break down your question in two parts, right? So other than robust order execution, as well as our momentum on, deliveries, etc., continues for the other half of the year, we are quite confident we'll be able to maintain these margin profiles. On the other hand, we've been focusing now for several years on strengthening our balance sheet, and that also contributes to margin profile. And we've got our order balance sheet today at one of the strongest that we've ever been. Our debt to equity is at 0.29 on a standalone basis, and that shows the strength of our balance sheet. We had spoken about order guidance last year, and in line with that, we said we will try and increase our consol PBT by 100 bips, and we've achieved that already at H1, and we are quite confident to sustain that order PBT momentum for the end of the year, and trying to get to 5.5%, which is the higher band of our projection for PBT on a standalone basis.
But Amit, you were talking about your guidance about revenue. I believe you've maintained it in that 20 to 25% range, right? So just if you could take us through what gives you this kind of confidence, and is it possible that you may exceed this level as well beyond 25%? Is something that we could see in the second half of the year? And also, which are the segments that are going to drive this key growth for you?
So, when we started the year, 20-25% order booking for a full year basis, both on console and standalone, was already a very aggressive target. Looking at our performance in Q2, where both on standalone and console, we are up 33% in revenue. We are now upping our guidance to 25%, which is the higher band of our, guidance for the year in revenue. And we are quite confident that we should be able to achieve that. Exceeding that order guidance, let's see where we end up at end of Q3, and if we need to do something, we may. But at the end, currently, as we stand, we are already guiding towards not 20 to 25, but 25 and 25 plus. So far as contribution to that revenue, our oil and gas, our urban infra, transmission, and BNF all have had significant growth in revenue and in margin. Also, our subsidiary in Sweden, Linje Montage, has been doing exceedingly well, both in terms of profit as well as of revenue growth, exceeding our guidance. And I think with that trend continuing, we should be able to get to where we've guided to be at the end of the year.
Good to know that. So all cylinders are definitely firing for you. But Amit, lastly, how much of that 2,400 crore capex that you have planned has been translated into the productivity benefits, and how much that we have already been occurred out of this in the first half of FY26? Give us some visibility.
So I think when you talk about 2,400 crore capex, it's over the last 5 years. We've had around 650 odd crores capex planned for this year, and I think we should be thereabouts. We've entered in building capabilities of the future in solar, in data centers, in very high end material handling projects, underground metro tunneling systems, because of which we've been spending this capex on buying tunnel boring machines, expanding our manufacturing capacity for towers. And now our factories stand at 250,000 tons of steel fabrication every year, which is a huge bump up from where we were 5 years ago. So a lot of this capex has been realized, making us ready to take that business and the growth that is coming, as you can see in our numbers. And so, yeah, we will be at this 650 crores capex for the year as we've guided at the beginning of the year. If we need to revise that towards Q4, we'll come back to you. But as of now, that looks to be where we are.
All right. Thank you, Amit. On that.